Hi, I'm Brian Spinelli, Co-Chief Investment Officer for Halbert Hargrove. I wanted to address the upcoming issue that markets are grappling with right now, which is the US debt ceiling, and give you our thoughts around what we see unfolding. Right now, there is no negotiated deal, and the debt ceiling is quickly approaching its limit in early June. Do we know the exact date? No, but estimates are right around the first week of June, the US hits its debt ceiling and can no longer pay on its debts. At this point, what Congress is doing is trying to negotiate a deal, and we do see incentives on both sides to get this deal done. We can use history as a guide here, and if you go back quite a few years to around the July 2011 timeframe, you can see how markets reacted to the last time this became a big issue in this country. For example, in July 2011, the US equity markets began reacting quite negatively to a potential debt ceiling hit. And around that same time period, what we would expect is that stocks would become extremely volatile by the measurement we follow, and they did. But shortly thereafter, volatility dropped significantly and stocks began to recover in a relatively short period of time. The other event that occurred in that same short time frame, right around the beginning of August, Standard & Poor's downgraded the US government from AAA status to AA status, which was historically a significant event. The US has never had a downgrade in its credit history. So in this instance, as we move forward to now, that's a pretty big incentive to get things done because that credit rating is important to the world. And we do believe politicians are aware of that. So while the incentives are pretty high right now to get a deal done, the timing around whether or not that deal is going to happen is the difficult part. The closer we get to the date, we do expect that stocks will probably become more volatile. Right now, they have not been. What's been the most volatile thing in the market is the 1-month US Treasury note or Treasury bill. It has skyrocketed in yield from around the 3.5 range upwards of 5, which is pretty significant as traders try to position for maturities that are a little bit further away from this debt ceiling impasse. So that seems to be a dislocation in the market, but relatively not affecting the overall stock market at this point. Could that change? Yes. And what we want to set an expectation around is that stocks can become volatile the more uncertain things become. But in this instance, eventually they will reach some sort of an agreement and stocks will move beyond it and onto the next thing. So for a long-term investor who's well diversified, owns stocks, bonds, and alternatives, while the stock part of the portfolio gets the most attention from headlines, we do think you have the ability to ride through this period and that stocks will move beyond it in relatively short order. So we understand the angst around this event, but recognize we saw this again in 2011, or we saw this before in 2011. Markets are reacting differently today because this is not necessarily a new issue, and they have seen how this has gone. So hopefully that gives you a little insight. We are continuing to monitor the situation, and hopefully we can come back if there's a change in it and update you accordingly. Thanks so much for watching. Have a good evening.